1 out of every 4 people will be disabled in their lifetime. When this occurs, they may have loss of wages, which affect the ability to maintain their standard of living. Many people assume that the government or the employer will provide these coverages. Though this may be true in some cases, there may be qualification requirements, and coverage may be limited. The state only provides short-term disability, and you have to meet qualifications, while there are even stricter rules with the federal program. Due to this reason, purchasing a private disability insurance is advisable. There are many coverage options and premium can be affordable. So let's take a look at these options. Short-term disability refers to coverage provided from a few months up to 5 years. Premiums for these policies are reasonable and allow the customer time to adjust to these changes in their lives. It also tends to be used to cover short-term obligations such as car payment, student loan, and short-term personal loans. Coverage amount is generally limited based on a person's income and occupation, ranging between 40 to 70% of an individual's income. Long-term disability describes coverage from 5 years up to the age of 65. Very few companies will ever offer lifetime coverage because most people will work until the age of 65, and if they are able to maintain the same income, they should be able to have a retirement plan that would allow them to maintain the standard of living after this age of retirement. Long-term disability is an ideal option, though the cost can be much higher. However, if you take into consideration that if a person becomes disabled, 1 month's premium will provide for possibly a whole year's of wages, then it may be worth the customer giving up a night or 2 of eating out to ensure income protection for their family. Like short-term disability, eligible coverage amount is commonly determined by a person's income and occupation ranging between 60 to 80%. When a person owns a home and carries a mortgage, they are qualified for mortgage disability. The qualification is based on the lower comparison of the mortgage payment and the customer's income. Another factor that makes mortgage disability insurance a bit different is that it is based on the term of the mortgage and may terminate at the end of its term. The idea here is to help assist the customer in making the mortgage payment while they are recovering or situate their life if faced with long-term disability. So we talk about the 3 types of insurance policy described, and it can stand alone or can be stackable, meaning purchased together. The percentage provided by disability policy may not add up to 100% of the customer's gross income, even when stacked, because most insurance carriers take into account the state and Social Security disability qualification. Premium for disability is based on the customer's occupation. Outside of the primary disability coverage, many insurance companies will offer additional endorsements such as inflation riders, providing automatic coverage increase to offset potential increase in income and cost of living. Another common rider is the Social Security rider, which allows the customer to have additional coverage if they are declined by the federal program. In addition, consideration for the waiting period is crucial. There can be a fixed dollar amount or a certain time period of disability before coverage is paid out. Consideration for this decision would be dependent on how much the customer can afford to wait or put out of pocket before needing the insurance carrier to start making payment. As always, the more the customer can take on, the lower the premium will be. To aid the customers in figuring out the needed disability coverage, a disability income calculation worksheet is helpful in determining the right product for the customer.